What are the most useful crypto indicators for beginners? When you open a crypto chart, you may see many different indicators: moving averages, volume, RSI, MACD, VWAP, and many more. But beginners do not need to use everything at the same time. Too many indicators can make the chart confusing. In this video, we will look at 5 common indicators that can help you understand the market more clearly. Bitcoin is used only as a chart example. This is not a coin recommendation. The first indicator is MA, or moving average. A moving average smooths the price and helps you see the general direction more clearly. Instead of focusing on every single candle, it shows the average price over a selected number of candles. For example, MA7 follows the price more closely. It reacts faster because it uses a shorter period. MA25 is slower and shows a more medium-term movement. MA99 is even slower and can help show the broader trend. A simple way to think about it is this: MA7 shows the short-term direction. MA25 shows the medium-term direction. MA99 shows the bigger trend. If the price is above the moving averages, the market may look stronger. If the price is below them, the market may look weaker. And when a fast-moving average crosses a slower one, some traders watch it as a possible trend change. But moving averages are delayed indicators. They follow price. They do not predict the future perfectly. The second indicator is volume. Volume shows how much trading activity is happening. This is important because price movement with strong volume usually means more market participation. For example, if price moves up but volume is very low, the move may be weaker. But if price moves up with rising volume, the move may have stronger support from the market. The same is true for sharp drops. A big red candle with high volume can show strong selling pressure. So volume helps answer one simple question: is this price move supported by real activity? The third indicator is RSI. RSI means Relative Strength Index. It is a momentum indicator. It helps show whether price has moved too far or too fast in one direction. Many traders watch the 70 and 30 levels. When RSI is above 70, the market may be considered overbought. When RSY is below 30, the market may be considered oversold. But this is where many beginners make a mistake. Overbought does not always mean price must immediately fall. Oversold does not always mean price must immediately rise. In a strong trend, RSI can stay high or low for a long time. So RSI should not be used as a simple buy or sell button. It is better used as a warning sign. It can tell you when momentum is getting stretched. The fourth indicator is MACD. MACD stands for Moving Average Convergence Divergence. It sounds technical, but the basic idea is simple. MACD is used to understand momentum and possible trend changes. It usually has 2 lines and a histogram. When the MACD line crosses above the signal line, some traders see it as a possible bullish momentum signal. When the MACD line crosses below the signal line, some traders see it as a possible bearish momentum signal. The histogram shows how strong or weak the momentum is becoming. If the histogram bars are growing, momentum may be increasing. If the bars are shrinking, momentum may be weakening. MACD can be useful because it combines trend and momentum ideas. But like moving averages, it can also react late, so it should not be used alone. The fifth indicator is VWAP. VWAP means Volume Weighted Average Price. It shows an average price level that also considers trading volume. A simple way to understand VWAP is this: it can help show whether price is trading above or below a volume-weighted average level. If price is above VWAP, the market may look stronger in the short term. If price is below VWAP, the market may look weaker in the short term. This is why many short-term traders pay attention to VWAP. But again, VWAP is not a guaranteed signal. It is a reference level, not a prediction. So how should beginners think about these indicators? Moving averages help you see trend direction. Volume helps you understand whether a move has strength behind it. RSI helps you see whether momentum may be stretched. MACD helps you track momentum changes. VWAP helps you compare price against a volume-weighted average level. The key point is this: no indicator is perfect. No indicator works all the time. And no indicator should replace risk management. Indicators are tools that help you read the chart. They are not automatic trading decisions. A better approach is to combine simple information. For example, trend from moving averages, strength from volume, momentum from RSI or MACD, and short-term reference from VWAP. When different indicators tell a similar story, the chart becomes easier to understand. But when they disagree, that can also be useful information. It may mean the market is unclear, and sometimes not trading is also a decision. So the simple rule is this: use indicators to understand the market. Do not use them to blindly chase signals. The goal is not to add more indicators. The goal is to read the chart more clearly.